Okay, welcome everyone to our webinar for creating a tax-free legacy for your heirs. Before I get started, I just want to remind everyone, if you haven't already done so, please mute yourself. I've been trying to catch everybody, but you notice you're unmuted. Please mute yourself. All right. Welcome everyone to our webinar for creating a tax-free legacy for your heirs, presented by Whitehawk Management. We're excited to have you on our webinar today, and we're glad you could make it. We are recording this webinar today, and we will distribute it to everyone that signed up. In just a moment, I'll bring on JD White and Cameron Dye to show you how they have helped hundreds of families manage their potential tax bill that they passed on to their beneficiaries. Both JD and Cameron are certified financial planners with a combined experience of close to 20 years in the industry. They are both former athletes at a high level and pride themselves on being the best they can for their clients. I'm showing you our disclosures for this webinar. The information discussed today contains a lot of discussion around taxes and estate plannings. We are not tax preparers or attorneys, and this is not intended to be a substitute for specific individualized tax advice or legal advice. We suggest that you discuss your specific tax issues with a qualified tax advisor and an estate attorney. We will have some time at the end of this webinar for a Q&A. Please use the chat box at the bottom of this window, and we will get to whatever we can at the end of our presentation. We have also asked that you provide some questions during registration, which we will also cover during that time if it wasn't already addressed. Now, without further ado, please welcome Whitehawk Wealth Management's very own JD White and Cameron Dye.
Hello, everyone, and welcome to our second webinar of 2024. Thank you, Jennifer, for the great introduction. We're looking forward to showing all of you how we have helped our clients to start thinking about managing the tax bill that they pass to their beneficiaries and some of the strategies that we implement to accomplish this. We'll discuss some of the regulations that have recently passed that are going to cause headaches for non-spouse beneficiaries specifically, and how we can get ahead of it. All right, so on the next slide, so you'll see here, this is a graphic that we use quite a bit, but we have modified it for this webinar. And so when we typically think about passing assets to our next generation or any beneficiary, there's different tax buckets that we think about. Each bucket has kind of a different way that money goes in and a different way that money goes out. And we think about this typically when we think about retirement, but in this case, we want to talk about how it's going to pass to the next generation. So the most common one that we see is the pre-tax bucket. So that's going to be where you're kind of kicking the can down the road. So we're throwing money in. That's going to be your 401k. When we retire, it's usually IRAs, all the IRAs except for Roth. On the beneficiary side, and we'll get into the specifics of this more, but they've got 10 years to pull the money out. They've got to pay 100% tax on it as it comes out. And there's some specifics there that we'll get into later. For the taxable bucket, which is, we pay some of the taxes as we go in the form of capital gains, dividends, and interest. That's typically our savings accounts, our investment accounts that aren't deemed for retirement. So like joint accounts, individual accounts. This can also be, houses, personal property, stuff like that. It's a nice bucket to pass because you will get a step up in cost basis, which again, we'll talk about in more detail. And these can also get stepped down, which is not as favorable for beneficiaries, but not a bad thing to pass to our other generations. And then we got the tax-free bucket, which is our favorite bucket. We pay the taxes before money goes into that bucket. When it goes to the next generation, if it's a non-spouse, they're still going to have the 10-year window to pull it out. but it's all tax-free. So any money that we pull out of that bucket has already been taxed. It grows tax-free. We can get it out tax-free. So we like that. Employer plans, so 401ks, 403bs, if we pass away and we still have those intact, some of those do have different rules. So they might not have the 10-year rule. Some of them will have a 5-year rule instead. Again, we'll cover that in a little more detail as we move on. So Cam, there's an estate tax rate. Can you tell us a little bit about that?
Sure. So, morning, everybody. The estate tax is a progressive tax. So similar to income tax, it goes up depending on the amount of money. There is a very large exemption right now that we'll go into further detail later. But if you are just over the exemption, you're looking at an 18% tax rate. That goes all the way up to, if you're $1 million over the exemption, you're up at 40%. So it's a pretty big hit to the beneficiaries. It's a big reason why we want to make sure that we really dial in the savings. So, getting more into the details about why we try and avoid passing pre-tax assets to beneficiaries. Big part of that is because then the beneficiary doesn't have any control over when the taxes get paid. They're forced to pay the taxes as the money comes out, and depending on whether they're spouse or not spouse, there's rules for that. But part of the reason why it's so detrimental in a lot of cases is because oftentimes people inherit money when they're in their own highest earning years. So just example, if your parents pass away at 85, they had you sometime between 25 and 35, that means you're between 50 and 60 right now, which ultimately is in the upper echelon of when you're going to be making the most money already. And anything you take out of a pre-tax inherited IRA or 401k, you're going to pay income tax on the whole thing. So that can really have some negative impact on you in each of those years for a lot of different reasons. We'll go into more detail later. And the other one is that beneficiary RMDs, so the required distributions from a beneficiary IRA, can't be converted to Roth IRAs and simply have to be taken as income. So there's just not a lot of control as to what you can do with that money, which is why when we can, we like to try and pay the taxes early and get it in a tax-free bucket. But JD, why don't you go over the other two pieces of that?
Yeah, and Cam, correct me if I'm wrong. We've had this happen this year with a client.
Yep.
So
Yep.
client we have, and this goes right into the next bullet point. This kind of jacks up the ability for the beneficiary, so potentially your children, our children, hurts their ability to do the financial planning strategies that we're trying to do for filling up their tax-free buckets. So we have client, their dad passes away, survived the mom, passes them a $350,000 traditional IRA. Well, now we have 10 years to get that money out, and it's filling up their taxable income bucket. So everything that we do for converting is based on how much taxable income we have. Well, RMDs, we can't, and we're going to get into more detail of this, but we can't convert it. So we have to take it as taxable income. Well, now there's less that we can convert. So we're trying to cover ways that we can kind of help our beneficiaries out and kind of pay the devil we know now. And honestly, there's the other part of this is, if we're talking about the same age thing that Cameron just mentioned, there's also things that are based on our income, like Social Security or Medicare premiums are based on how much income we have. So if we're forcing our beneficiaries to take income, we could be, creating tax on their Social Security. We could be increasing their Medicare premiums. So we could be doing all these things that we don't mean to do. Like at least I wouldn't. I like my kid, but we're doing these things usually on accident. We're not meaning. We're passing our kids money. That's a great thing. We're not meaning to actually, potentially cause them any financial harm. So Cam, let's jump to kind of some of the exclusions that we have available.
Sure. So as I was mentioning earlier, when we were talking about the estate tax, there's a lifetime gift exemption. So any person, when they pass away, their estate can be up to, this year it was $13.61 million. And then anything under that is tax-free. There's no federal tax relief. And the 18% starts when you go over that amount. If you are married, that's actually, the number gets doubled, because if one spouse passes away, their exemption any remaining exemption passes to the other spouse. So you can get as high as $27.2 million right now, that can be tax free. So that's, I mean, these are big estates. The one thing to keep in mind is that those numbers change. So JD, why don't you talk about how that number changes?
Yeah, I wasn't supposed to kick that over to Cam yet. That's my mistake. Like, Cam, you can do this whole slide.
Audible.
Yeah.
Yeah.
Yeah. So when we talk about the annual gift exclusion, it's kind of the amount that you can give every year without dipping into that lifetime gift exclusion. So, for example, if Cameron and I were married, which we're not, sadly, but we could combine our gifts and give $36,000. If we had two children together, we could give $36,000 each kid, or cousin, crazy Uncle Bernie, or whatever. So you can give $18,000 per person to a person without touching that lifetime exclusion. Once you go over that, then you start dipping into this exclusion. So if we gifted, if I gifted $25,000 to my son this year and didn't split, then $7,000 would come off of my $13.61 million. So these are pretty big numbers that we're not super worried about right now, but it is set to drop down some in 2026. Did we miss anything there? Did we cover all that?
No, yeah. I mean, I think whoever is in office, them and Congress are going to get to decide what happens with the Tax Cuts and Jobs Act having been enacted. That sunsets in 2026, like you said. And as of now, the exemption is basically going to get cut in half. So it's going to go from 13.6 to 7 million per. Again, you're talking about large amounts of money here with $14 million per couple. But if somebody has been planning in the last 3 or 4 years to have, 25, almost 30 million, and they've been working to keep that number under check, all of a sudden it's going to be, they're going to be scrambling in the next sort of year and a half to make sure they get under the new exemption if that does go into effect. So state attorneys are likely to be pretty busy here in the next little bit. Yeah, so JD, I mean, we know Colorado is the best state in the union, but maybe that's just my bias. But are all states created equal from an estate tax perspective?
Yeah, not so much. And let me tack on one thing on the other slide. When we say exclusion, we mean that you're not paying tax. So if you pass 13 million to your beneficiaries, there's no taxes owed to the estate. So Cameron mentioned, we'll hit it again. There's a large estate tax. It's like 40%. If you're under these thresholds, you don't pay taxes on that money that passes to the next generation. So just to be clear there, exclusion means no taxes owed. And that's federal. So, okay, now we can go to the next slide. But there's also states. So some states play by their own rules. So Colorado, for example, uses the same limits as the Fed, which is really nice. So we know we can pass 13.61 million per person to beneficiaries without having to worry about paying estate taxes. There are some states that have different rules. There's estate taxes in some states. There's inheritance tax in some states. There's both in some states. We have a client in Massachusetts, for example. Last year, it was actually only $1 million. Now it's a whopping $2 million. So in Massachusetts, if you pass assets that are over $2 million, you have to pay their state taxes on that money. So kind of interesting things to think about. Again, if we're looking at trying to avoid these things, or if we're over the threshold, we really have to get estate attorneys involved. And you got to do it way ahead of time. And it's a little more complicated than what we're going to cover today, but there are ways around it, but you really have to pay the money up front to do it. So yes, no, all states are not created equal, but we do live in a state, at least here, that plays by federal rules. But you can kind of see on the graphic here, and we've sent this out. It's most states play on the federal rules. So, all right. So Cameron, let's dive into the 10-year rule that was came out in 2020.
Yeah, so getting into a little more detail how this actually works. This affects anybody who inherits from someone that passed away after 2019. So I think we'll touch on it later, but if you inherited something in 2014, different set of rules. These only impact the last sort of 4 years so far. And I'm going to go over the spousal beneficiary options. So this is in the case of if you are married and your spouse passes away. You have two choices, more or less, as to what you want to do with that money. You can take that money from, and again, this is pre-tax money we're talking about here. You can take their IRA, for example, and you can roll it into an inherited or beneficiary IRA account. Once it's there, you can delay distributions until they would have turned 72. You can decide to take the distributions based on your own life. So if you were younger, you could delay that a few years. Or you could follow the 10-year rule. I don't know why anybody would ever do that, but they could. Or the preferred option in almost every case we have ever seen or talked about would be to take the money from your spouse's IRA or 401k and roll it into your own IRA. Or if you didn't have one, create one. Because that gives you a lot more control as to taking the distributions from it, because it can be based on your life expectancy. So say you inherited money from somebody that was 71 and you are 61, if it's in your IRA, you can now wait until you're 73, another 12 years before you're going to be required to take any distributions from it. If the person you are inheriting from was already taking distributions, so if they were already 73, today's numbers, you can either continue to take the distributions as they would have, if that's, if the income makes sense and you need it, then you can do that. Or you can, again, take it based on your own life expectancy. But that's the straightforward case. Like there's no, the 10-year rule doesn't even really apply if you're a spouse. You sort of play by a different set of rules. It's the last great exception in this case. But JD, what happens if kid inherits or non-spouse inherits from somebody with an IRA?
Yeah, so there's the non-spouse beneficiary options, and there's one caveat here that the non-spouse has to be more than 10 years younger. So if you pass assets to like a brother or sister, they might be able to play by different rules. But for purposes of today, we're going to focus on if they're 10 years or younger, because we're talking about children, grandchildren. So the only option is the 10-year rule. You keep it as an inherited account, so it becomes a beneficiary, like beneficiary inherited IRA, however you want to label that. And you have to take the funds have to be out by the 10th anniversary of the date of death. And currently the IRS is not making you take money out. So, and we might think we cover that a little bit later.
Yeah, we cover that later.
Yeah, we'll dive into that. All right, so let's dive into kind of a snapshot here of how money actually, passes just high level to non-spouse beneficiaries. So we've got the 10-year rule in play for a lot of these, but different accounts, different rules. How does it get taxed? So diving into a little more detail here. So the pre-tax bucket is what we typically think of as 401ks. When we roll those out, it could be traditional IRAs. We've got SEP IRAs, simple IRAs. So the traditional IRA, SEP IRA, simple IRA. So all the IRAs except for Roth, it's gonna be a 10-year rule. So it passes to a non-spouse. It's a 10-year rule. All the money that comes out is taxed 100% as ordinary income. So if you take $100 out of that, you just added $100 to your taxable income. 401ks, 457s, 403bs, so all the 4 whatever employer plans. So these are retirement accounts that we contribute to through our employer. They can vary by plan. So some plans will have a 5-year rule that are on there that'll say, hey, these funds have to be out within 5 years. They kind of have their own rules built into them. But a lot of them are still going to be a 10-year withdrawal period. So we'll see 5 and 10 year on a lot of those. Again, money comes out 100% taxed as ordinary income. $100 out, You just added $100 of taxable income to your tax return. Cam, why don't you, we see a little bit, something a little bit different with the tax-free bucket.
Yeah, so I mean, just I guess continuing the laundry list of reasons why we like the tax-free bucket better. Technically, you must play by the same rules. So if you are a spouse, you can roll it into your own account. If you are a non-spouse, more than 10 years younger, you only have 10 years to liquidate the account. The giant caveat being, if the taxes are already paid, then you have 10 years to do anything you want. If you want to take all the money in the first year, you can do that. If you want to take all the money after 10 more years of growth in the 10th year on the last possible day, you can do that as well. Because the tax were paid when the money went into the account, the beneficiary has full control. They can take the money whenever they want. They have to get it done by the end of the 10th year. So a beneficiary Roth IRA must still be liquidated, but there's no taxes. So again, you can do it totally on your own schedule. There are some 401k Roth versions that have slightly different rules. They might be on a 5-year clock there. But again, because it's tax-free, there's nothing to stop the beneficiary from taking the money when they need it, when they want it, or on the last day of the 10th year. That's sort of the final call. But it gives the beneficiaries so much more control over when they're going to take the money and how they're going to use the money, that it's a big proponent as to why we try and fill the tax-free bucket as much as possible before somebody passes away, and kind of leave the beneficiary with a ticking time bomb of a clock. So I think next slide, we're going to dive into a little more detail here. We've covered.
Can I go off script real quick?
Yeah, Doug, go for it.
I have a question.
Okay.
So Cam, I inherit a $100,000 Roth IRA from my mom. She doesn't have that. I don't think she's on this. I inherit a $100,000 Roth IRA from my mom. I cash that out tomorrow. I go buy myself that Ford Raptor Bronco that I've had my eye on. What are the implications to my tax return?
Nothing. I mean, you got to tell somebody. There will be a form that the account got liquidated, but nothing. It's
pretty sweet.
The second you inherit that Roth, it's your money, and it's basically a checking account. There's no taxes. Even if you left it there, say you left it there for 10 years and bought the Bronco Raptor of 10 years from now, you just have more money to buy it with, because all of the growth in that account is also tax-free. So yeah, whether you took it tomorrow or whether you take it in 10 years, however you do it, it's your money to play with.
Yep. Tax return, line 4A, $100,000 distribution. Line 4B, taxable amount, $0.
Zero taxable. Yeah.
Thank you, Cam.
It's a pretty awesome situation for those that are able to plan for it for their beneficiaries. So we've covered a lot of this 10-year stuff. So again, somebody passes away, leaves an IRA for somebody, a pre-tax IRA. By the last day of the 10th year of the anniversary of that money has to be gone. The IRS is not currently requiring beneficiaries to take distributions. And this has been a little weird. This kind of goes with anything involving COVID at this point, where the rules kind of keep changing, and then they change a little more. And distributions were supposed to be required for those that had already been taking distributions when this rule went into effect in 2020. So if you inherited an IRA from somebody that was in their 80s and they were already taking distributions, you were supposed to have to at least continue taking the distributions they would have taken. And then you had 10 years to liquidate the rest of the account on your own schedule. But they haven't been requiring that, mostly due to COVID. So 21, 22, 20, and they even have said so far this year, you're going to be fine. If you decide not to take any money out, that's your prerogative, I guess. Ultimately, you may be penalizing yourself down the road. JD is going to go into more details here. But when we see inherited IRAs, we generally put people on a clock. So JD, why don't you go into a little bit of detail as to how that actually works with the numbers?
Right. So we've created an in-house spreadsheet that we use. And honestly, I think everybody on this is a client, but if you're not a client, we can give this to you. And if you are a client and you want this, we can give it to you. But we like doing this work. So we've created a spreadsheet that takes an even distribution of the account balance, given a kind of a growth rate, depending on the client's account. So depending on how it's invested, we'll plug in a different growth rate. And then we try and make it so that the tax bill is even throughout all 10 years. Now, the accounts don't move in a straight line. So what we do is we essentially, after we take year one, we're going to delete that out and we'll put in the new balance on year two. And so we're going to continue to try and make it even as we move through it. And it works out really nicely. We also know that clients have circumstances. So if we have a client in a low earning year, might as well take more of that RMD so we can get rid of that ticking time bomb, which is money that we have to owe the IRS. And we can't convert it. So now the other side of this equation is, a lot of people in our seats are not paying attention to this. And so what happens if we actually kick this can all the way out to 10 years, the same amount of money, 350 grand, 6% growth rate, we kick this out to year 10, all of a sudden we've got to take $626,000 and pay $200,000 of taxes on that in a 24% rate. Now, in all reality, we take $600,000, we're married filing jointly, we're actually going to jump into the 32% bracket. So we're creating a much larger tax bill by kind of delaying this. So we don't joke, but we do call it a ticking time bomb. People that aren't paying attention to this could be in for a rude surprise down the road. All right, so Cam, let's talk about. So we talked about the ticking time bomb. What are the ways that we have typically, when we're in retirement? What ways can we still fill up the tax-free bucket?
Yeah, so unfortunately, the options get real small. For people that are still working, you can get money into a Roth or a tax-free bucket in sort of 4 different ways. Right? You can just contribute normally if you're under the income cap. You can convert money over time. If you're over the income cap but you don't have an IRA, you can do a backdoor Roth contribution, or your employer can match in a Roth, which that's sort of a new concept for employers to offer that in the 401k, but that is an option for them to put their matching contribution into a Roth K for you. But as you can see with the 3 giant red X's, all of those options either require earned income and or you have to be employed to get an employer match. So effectively, those 3 options go out the window. And the only way, once you have retired, to get money from your pre-tax bucket, your IRA, your 401k, into your Roth IRA, your tax-free bucket, is to convert. So, we'll go through some more details of that, but that really is something that as people go into retirement, a lot of times their income comes down, makes a lot of sense to look at. But, ultimately that is the only way really to get that money over. So if we dive into some more of an example here on the next slide. Yep, there we go. So the strategy for moving money over is, again, it kind of comes to control, right? The devil, you're going to have to pay your taxes. The only thing guaranteed is death and taxes. So the idea is that taking the money earlier on and moving it when you want to and can, as opposed to when you have to. Because ultimately the taxes are either going to be paid by the person with the IRA now, later, or by their beneficiaries. One way or another, any money coming out of a pre-tax bucket is going to be taxed fully. The IRS is going to get their money. Uncle Sam gave you the deferral early on, which helped. Now they want to be paid. So ultimately, the conversion is a way to pay a known tax number. Oftentimes, the question becomes like, do you think taxes are going to go down in the future or not? And then you can sort of create the timing based on that. But JD, why don't you go into this example of sort of some of the bad parts of why this doesn't always work if you leave it in the pre-tax bucket?
Yeah, and this is probably my least favorite thing to think about. But actually, let me interject one thing there. Something to think about when we think about conversion. If you retire and do like part-time work, even if you make like $10,000, really important for people like us to know that, because if you have any earned income at all, you can contribute to the Roth IRA. So just keep that in mind. But otherwise, so when we grow money in the pre-tax bucket, the hardest thing for me to think about is that we're doing all this work, we're trying to grow those assets, and ultimately the IRS and the state are going to benefit from that work. Most states, not all states, remember, different rules. Like Texas, I know someone on here is from Texas, at least one. there's no state tax in Texas. So, but at least the IRS is going to benefit from that growth in the bucket. So just hypothetical example here. We have $100,000 in a traditional IRA. We grow it at 10%. The taxes that we're going to pay on that, if we retire and we're paying 24% to the Fed and a 5% state tax, we're actually only getting 7.1% return. And we won't even know that until we withdraw the funds and pay the taxes on it. So if we're averaging 10% every year and we're compounding it, we're actually also compounding the 24 and 5% that we're going to pay in taxes. So it's kind of, we want to get ahead of it. We want to be talking about converting earlier than later, even if it's, little pieces. In a perfect scenario, we actually take the $100,000 here and we convert it and we pay the $24,000 out of a taxable bucket. So like a savings account. That way we can move the entire $100,000 over into the tax-free bucket instead of moving over $71,000 and sending $24,000 to the Fed and $5,000 to the state. So that's kind of the nerdy numbers that we look at. Cam, let's talk about, we fill up this tax-free bucket. What can we do with this tax-free bucket other than buy a Ford Raptor Bronco?
You can go buy anything you want, brother. So there's a couple ways we look at this. The biggest piece, and I guess the goal is, again, control, right? Keep your options open and limit your taxable income. Because again, anytime you're forced to take money out of that pre-tax bucket, whether it be for pleasure or because you have to, you're going to be paying a tax bill. If it's already in a tax-free place, you can take trips. You can, get that new kitchen remodel you wanted. You can also do things that kind of just have to be done sometimes, where you help out a family member. If you run into a long-term care event and you don't have good long-term care insurance, this is a great way to take care of that, because again, you know exactly where the money is, how much you have, there's no taxes due, and it doesn't affect your taxable income, which that's the key for the bottom part of the slide here, where the costs that we're actually trying to avoid are if you're in retirement and getting Medicare. If you have to take a huge distribution from a pre-tax account to cover a long-term care event, it might also doubly impact you in the following year. Your income was significantly higher, so now your Medicare premium is significantly higher. And you may have also been bumped into a higher tax bracket. And now if you're in a higher tax bracket, your Social Security might be getting taxed more. Instead of at 50%, you're getting taxed at 85% in your Social Security. And then lastly, it can affect capital gains. So ultimately, it does really come down to the control of the money and the taxes and being able to decide when you're going to pay stuff and doing it on your schedule, as opposed to being forced to sort of scramble. And if you need the money, you need the money. And certainly nobody would ever tell you not to take it out of a pre-tax bucket if that was the place to get it. But it does potentially impose some shadow costs, which are sort of the bottom of this slide. And it makes doing the fun things, require a little more planning to make sure you don't incur any of those shadow taxes by taking that dream vacation that you work so hard to do. So that's sort of how we look at this. Like it's the control, and it's keeping that taxable income low. JD, what about a surviving spouse conversion?
Yeah. So the biggest kind of caveat to this whole thing, and I'm gonna reference that last slide real quick. We have a graphic for shadow taxes. I'm gonna put a plug in here, but it's kind of a scary graphic, so we didn't use it. But we do have a educational email that's going out to all of you, our clients. If you're missing any of those or not seeing them or want to go back and see the old ones, we have created a tax education blog on our website. You can go check that out. You can see the scary shadow tax graphic on there. We're updating that weekly, so we're getting those out. So it's catching up to our weekly emails that we're sending out. So little plug there. Just go to our website and you can go to the tax planning page, and there's a big link in there. Anyway, thanks, Jennifer, for going backwards. All right, so let's talk about the one exception we have to the inherited IRA. So we're a surviving spouse. Not a great situation to be in, right? Cam and I have dealt with clients. My mom is a surviving spouse. She's a widow. We've seen the goods and the bads of these things. There really is not a lot of good. to come out of these situations. But for us, this is maybe a little silver lining. So as a surviving spouse, you can actually move the assets into a beneficiary IRA, and you can delay the distributions. So that's the required minimum distributions, RMDs. You can delay that until you would have turned 72 or 73, depending on when you were born. You could take the distributions on your own life expectancy, or you can follow the 10-year rule, which we don't recommend. That's if you move it into a beneficiary IRA. If you move, we say IRA a ton in this thing. If you move it into your own IRA, which is what we recommend, now we can kind of follow the normal rules that you would anyway. And one of those things that we can look at is conversions. So you actually have the ability to convert versus a non-spouse beneficiary. They have to take the RMDs, they have to pay taxes, and they essentially have to put it into a taxable bucket and then follow normal rules. So they have to fill up the income bucket and then play by the normal rules. For a surviving spouse, we can actually still convert it as if it was our own. If we have to take RMDs, then yeah, we have to take those and we have to fill up the taxable bucket, the taxable income bucket. But we can still convert on top of that. It just becomes a little more difficult. But we can convert those funds, which is honestly probably, as we're transitioning someone from a dual income household, we see the income drop, we see the expenses drop, and this could be maybe the only silver lining in an otherwise pretty dark time. As we start thinking about the next generation, typically when we have some sort of death like that, we start thinking about the kids, the grandkids, and how we can take care of them. So this is kind of, for us, a silver lining as far as financial planning goes. It's not like, we have time to work through that. So, all right. So Cam, let's talk about the neglected bucket.
Yeah. So most people are pretty aware of pre-tax because they got a 401k at work, and they might have a Roth IRA from when they were, first out of college, not making very much, but trying to save something. Oftentimes, the biggest piece of wealthy people's estates is their taxable bucket. It's just an investment account that they've been putting money into for a very long time. They sold houses, they sold businesses. This is the place all of those assets go because they're not qualified. They can't fit into one of those neat little IRAs, and there's no contribution limit. You can put any amount of money into here at any time. So this one kind of gets left behind, but there are a lot of really big advantages to the taxable bucket. The biggest being, we covered it in the very first slide of this whole presentation, how capital gains are the tax on here. There is no income tax on a taxable bucket. So you can receive a half step up in cost basis if you are a spouse. So say you have a joint account, one spouse passes away, you get a half step up in basis. If both spouses pass away, the kids inherit the account, it gets a full step up in basis. So what that means is parents bought, in this case, we'll go over here, just go through this example because it makes it very relatable. But keep in mind, this includes houses, collectibles, basically any investable asset that is not in a qualified retirement account. So just fun with numbers here because they're kind of fun to see, and that's why we invest in the stock market. Married couple buys $10,000 worth of Apple stock in January of 1985. Gets the dividends reinvested all along the way. Husband passes away in 2014. So, about 30 years later. And the stock is now worth $2.455 million. And just for the record, these numbers are real. So if you had made this amazing investment, you'd be pretty psyched with it. Husband passes away. So what does that mean? This is that half step up in basis for the surviving wife. If the next day the wife says, you know what, I want to get rid of this money, I want to use it for something else, I no longer want to hold this investment, her cost basis is going to be $1.232 million. So we take that full amount of what the cost basis is, we subtract the original money put in, divide by 2, and then add back in the original amount. And that gives us the cost basis with the half step up. So she's only paying taxes on her half effectively. And then you would owe capital gains of $1.22 million. So that's the half step up. But JD, what happens if wife decides, yeah, you know what, this is done pretty well, I want to hang on and we'll give it to the kids someday? How's that look?
Yeah. So fast forward. So wife decides to not sell the Apple stock. wise decision, and ends up passing away July of this year. The stock is now worth $22.1 million. If that passed the beneficiaries, and I'm not getting into the estate rules, we already covered that.
Because they were getting pretty close to estate tax.
Yeah, we're all of a sudden we're getting close to the thresholds. Now she does get to use her husband's. If he didn't use that 13.1 million, she gets that. So we'd be at 26 million. She would have that full amount.
Yep.
What's 22.1 million. Beneficiaries sell the stock the next day. Doesn't change in value. They would not owe any capital gains tax on that. Estate tax would be the only thing they'd have to worry about. So that's really nice. I mean, the full step up's great. The half step up's great. And this works on houses, gold coins, you name it. You just got to keep track of the dates and have a way to find the values on those half step ups. And the full step up, date of death is everything gets recorded pretty well. That's again where your tax preparers and your estate attorneys come in really handy, and us, of course.
Yeah. And real quick, I was just going to throw in, this is the place where if you are in the situation where, again, no inheritance is a bad inheritance, but if you inherited a beneficiary IRA, you're forced to take these distributions. You can't convert that money into your tax-free bucket. So oftentimes, if you don't need the money to live on and you're not doing anything with the money initially, at least, the taxable bucket in your account is the place where that distribution lands. So you can take the money you inherited, reinvest it in your own taxable bucket, and sort of situate your kids in a situation where if you end up giving all the money to your kids with that grandparents' money that's now been in a taxable bucket, they're going to look at this half step or full step up in basis. So you can sort of guide them as far as the taxes go based on the required minimum distributions you were forced to take from a pre-tax bucket.
Yeah, good point. Good point. So let's talk about talk about GSTT, generation skipping transfer tax. So let's say hypothetically I want to pass. I decide I want to pass some money to my grandkids as well. I want to take care of more than one generation of my family. Can I do that? Absolutely. And honestly, anyone that's over 37 and a half years younger than the decedent is considered a kind of a generation skip. So I guess if you had kids when you were 40, that could qualify as well. But the thing to think about with this is that the generation skipping transfer tax rate is a flat 40%. So kind of the same as the estate tax. And the thresholds are the same. So if you don't cross over the 13.61 million per person, it's still not going to kick in. So you can pass up to those levels to the next, skipping the generation, go to the grandkids. You're really not going to run into any issues there. So this gets thrown around a lot as kind of a scary thing. But with proper planning, where the thresholds are right now, and even with the reset threshold, you're probably able to pass assets to that third generation without anybody owing any taxes. So that's kind of a nice thing right now that we're kind of nice place we're at right now. If you go over those thresholds, it becomes a little more complicated because we want to avoid the 40% tax rate at all costs. So that's where, again, we're getting the estate attorney involved and trying to figure that out. So Cameron, there's a small workaround for the 10-year rule and IRAs. Can you hit us with
Yes, sure. So this is I guess the caveat would be this is a fairly complicated process. So again, contact your estate attorney. We don't play estate attorney, not even on TV. So take this all to your estate attorney. But for charitably inclined people, there is a way to create a charitable remainder trust. So say I wanted to make sure that I took care of my kids in some form or fashion, but ultimately I want the majority of my estate to end up at charity of my choice, Children's Hospital. So I would have my traditional IRA, and before I passed away, I would set up a charitable remainder trust. When I pass away, money goes into a beneficiary IRA that's owned by the charitable remainder trust. So then I can distribute money from there to my beneficiaries based on what I wanted to do, give X amount of dollars. to my beneficiaries. I know generally would go either a certain amount of time or through their lifetime. So I think it's usually 20 years or until my kids were dead and gone. At which point the IRA, what's left of it, goes to the charity as the remainder beneficiary. So it's simply what the words mean. Anything that's remaining goes to the charity as the remainder beneficiary. There are some, there's definitely some fine print in there about how much needs to eventually end up with the charity. So generally these are fairly large accounts, or else the beneficiaries, the kids aren't taking a lot out of them, because there does need to be some amount left over. But it's a way for you to avoid the 10-year rule, because by putting it in this charitable remainder trust, you've sort of changed the playing field a little bit. You've said, okay, my kids are going to get X amount for a certain amount of time, and then it's going to go to the charity. So there is no 10-year rule if it ends up in this charitable remainder trust. So it's a good way to avoid the 10-year rule. Ultimately, any income that is taken by your children or whoever the living beneficiaries are is income tax. So that is taxable income. But then ultimately the rest of it goes to charity. So there's no taxes on that. But it is a good workaround if you are charitably inclined, looking to have a little bit more, again, control over who gets the assets and when. Still want to help your kids or your beneficiaries, but also want the money to eventually get to a charitable place. So JD, I think that's the last slide, man. I'll throw it over to you to kind of close this bad boy out.
Yep. So again, these are really complex strategies that we're talking about here, and we really want to get the whole team involved. We want the tax preparer involved. We want the estate attorney involved. We want us involved, and we want the efforts of everyone. But the key to this whole thing is knowing what you want to accomplish, personally what you want to accomplish, and then you just start chipping away at it. We've always said that something is better than nothing. I can tell you that as we're going through our tax return reviews right now, we're recommending anywhere from a $2,000 conversion all the way up to I've seen $80,000. So it really depends on the situation, but something is going to be better than nothing. These things take a lot of time to execute. If you're already a client of ours, we're working on these things. We're looking for opportunities. That we're trying to get the education out to you as much as possible. If you're not a client, we know these are complex strategies. We're maybe over talking about a lot of this stuff. If you ever want to talk in more detail about your specific situation, contact us. We can schedule a call. No cost, no pressure. We're happy to chat about any of this stuff. We've got the link there. You can just go to the website too and find it pretty easy. So I think that's it. And then I'm going to kick it back over to Jennifer.
Awesome. Thanks guys so much. That was super helpful. I hope everyone enjoyed it. We do have a couple minutes left for some questions. Our first question is kind of an example. I inherited an IRA in 2015 from my uncle, and I'm taking RMDs. Do I now have a 10-year timeline to take that money out and pay taxes? Cameron, if you're comfortable with that, let's pass that one to you to answer.
Sure. Yeah, so the short answer is no, nothing changes for you. We actually have a couple different clients that, inherited from whoever it was a long time ago. They've been taking distributions based on the age of the person they inherited from. And as long as it was before the first of 2020, you can sort of play by the old rules. You can take the distributions based on the age of the decedent. You don't have to worry about your age. You don't have to worry about a 10-year clock. Nothing changes. You're effectively just grandfathered in the way the rules were previously. So again, if the decedent passed before 2020, then you do based on their age, not on the 10-year clock.
Awesome. Thank you. We have one more question. I'll pass this one to JD. I am in a higher tax bracket and it doesn't seem like conversions make sense for me. What should I be doing to set up my kids?
Yeah, good. It's a good one. So you're in a high tax bracket. To be honest, most of the time when we're jumping up into the 32% and above tax brackets, we are not recommending conversions. It just, in most situations, we're seeing our clients shift down 1 or 2 tax brackets in retirement if they're in those high brackets. So what can we do if we're not recommending conversions? Again, we just want to find ways to chip away at it. Maybe we're doing, we assume if you're in a high tax bracket, it's probably because you have earned income. So we could maybe look at doing some Roth through the 401k. And then again, going back to that bucket, the neglected bucket, we want to fill up our taxable bucket. What a great way to have cost basis set up. So we really just want to kind of do what we can, knowing that we kind of still have to kick the can down the road a little bit on our earned income. We don't really, we can avoid paying taxes at the high tax brackets. Yeah, we want to max out our 401ks, kick that can down the road. But as soon as we're able to, or if we have a dip in income, we want to look at conversion. So you kind of take it year by year. Hopefully that helps.
Perfect. Thanks, Judy. Well, that is all the time we have today. Just wanted to thank everyone again for joining us, and we want you to keep an eye out for our next quarter's webinar. This will be 52 Shades of Taxes. All of your money gets taxed now and after death. So keep an eye out for emails and invites to that. As one last reminder, we are recording this webinar today, and we'll get it out to everyone as soon as it's approved by compliance. If you have more in-depth questions, please feel free to schedule some time with us to discuss those. And I hope everyone has a great day, and we look forward to seeing you again soon.